Welcome to Doc Does Financial History, where money, power, and history collide, and nothing is ever as simple as it looks. Imagine this. It's 2005. You walk into a bank. You don't have a perfect job. Your income is average. Your credit score? Not great. But none of that seems to matter. The banker looks at you, smiles, and says, "You're approved." Just like that. No deep background checks. No tough questions. No real hesitation. You sign a few papers, and suddenly, you own a house worth hundreds of thousands of dollars. It feels unreal. Outside, the world seems to agree with your decision. Your neighbors are buying homes. Your friends are flipping houses and making quick money. Prices are rising month after month. Everyone is saying the same thing. Real estate only goes up. So you believe it. A few months later, your home's value increases. You feel richer without doing anything. You borrow more money using your house as collateral. Maybe you even buy another property. Because why not? It feels like the easiest money you've ever made. But then, something shifts. The payments begin to rise. People around you start struggling. Homes go up for sale, but buyers aren't showing up anymore. Prices stop rising. Then they fall. And just like that, everything starts collapsing. What you just experienced isn't just a story. This is exactly how the housing bubble that shook America began, and how it turned into one of the worst financial crises in modern history. To understand how this happened, we need to go back a few years. In the early 2000s, the United States economy was recovering from a slowdown. After the dot-com crash and the shock of global uncertainty, the government needed to stimulate growth. So they made borrowing easier. Interest rates were lowered. Loans became cheaper. The idea was simple: encourage people to spend, invest, and buy homes. And it worked. At first, more people began buying houses. Demand increased. Prices started rising. And as prices went up, something important changed. Homes stopped being just places to live. They became investments. People started buying houses not because they needed them, but because they believed they could sell them later for a profit. And as more people joined in, prices kept climbing. This created a cycle. Higher prices led to more buyers. More buyers led to even higher prices. It felt unstoppable. But behind the scenes, the system was becoming dangerously unstable. Banks, eager to make more money, started lowering their standards. They began giving loans to people who normally wouldn't qualify. These were known as subprime mortgages. People with low income, unstable jobs, or poor credit histories were suddenly able to borrow huge amounts of money. And the loans themselves, they were designed to look attractive at first. Many had very low interest rates in the beginning. But after a few years, those rates would increase sharply. At the time, it didn't seem risky, because everyone believed housing prices would keep rising. If someone couldn't afford their payments later, they could just sell the house for a profit. That belief was the foundation of the entire system. But there was another layer to this story. Banks weren't just giving out loans and waiting to be paid back. They were selling those loans. They bundled thousands of mortgages together and turned them into financial products called mortgage-backed securities. These were then sold to investors all over the world. From big banks to pension funds, everyone wanted a piece, because they seemed safe. After all, these investments were backed by real homes. Real people making real payments. What could go wrong? The problem was hidden beneath the surface. These bundles included both safe and risky loans, but they were often given high safety ratings anyway. Investors trusted those ratings. They didn't fully understand what they were buying. And the entire system was built on one dangerous assumption: that housing prices would never fall across the entire country at the same time. By 2006, that assumption started to break. Housing prices stopped rising. At first, it was subtle. Then prices began to decline. And that's when the real trouble began. Remember those low introductory interest rates? They started to expire. Monthly payments increased, sometimes dramatically. For millions of homeowners, this was a shock. Suddenly, they couldn't afford their homes anymore. Defaults began to rise. People stopped making payments. Banks started foreclosing on homes. Properties flooded the market. But there was a problem. There were too many houses and not enough buyers. So prices dropped even further. And millions of people found themselves in a terrifying situation. They owed more on their mortgages than their homes were worth. They were underwater. This is when the crisis spread beyond homeowners. Those mortgage-backed securities that investors had bought, they started losing value fast, because the people behind those mortgages were no longer paying. Financial institutions began to realize something shocking. The assets they believed were safe were actually extremely risky. Panic set in. Banks stopped trusting each other. Lending slowed down. The financial system began to freeze. And then in 2008, something happened that changed everything. One of the biggest investment banks in the world, Lehman Brothers, collapsed. It filed for bankruptcy. This wasn't just another company failing. It was a signal that the entire system was in trouble. What followed was chaos. Stock markets around the world crashed. Major financial institutions were on the brink of collapse. The U.S. government had to step in with massive bailouts to prevent the system from completely falling apart. Companies like AIG needed emergency support. Banks that once seemed untouchable were suddenly fighting for survival. But the real damage wasn't just financial. It was human. Millions of Americans lost their homes. Unemployment surged. Families who thought they were building a better future found themselves drowning in debt. Entire neighborhoods were left abandoned. Homes stood empty. Communities broke down. And the impact didn't stop in America. Because those risky financial products had been sold globally, the crisis spread. Banks in Europe and Asia were affected. Economies slowed down. Businesses closed. Jobs disappeared. What started as a housing problem in the United States became a global financial crisis. So what caused all of this? It wasn't just one mistake. It was a chain reaction. Low interest rates encouraged borrowing. Banks became reckless in their lending. Investors chased profits without understanding the risks. Rating agencies misjudged the safety of financial products. And regulators failed to step in before it was too late. But above all, it was driven by belief. The belief that housing prices would always rise. The belief that risk could be ignored. The belief that the system was stronger than it actually was. After the crisis, governments introduced new rules. Banks were required to be more careful. Lending standards became stricter. Financial systems were monitored more closely. The goal was simple: prevent this from ever happening again. But here's the reality. Financial bubbles are not just about numbers. They are about human behavior, greed, fear, hope, and the idea that this time is different. Even today, some warning signs still appear. In certain places, housing prices have risen rapidly again. Debt levels are growing, and the same patterns slowly begin to show. So the real question is not just what happened in 2008. It's whether we've truly learned from it. Because history doesn't repeat itself exactly, but it often comes very close. The housing bubble that shook America wasn't just about real estate. It was about trust. Trust in banks. Trust in markets. Trust in the system. And when that trust broke, it sent shockwaves across the entire world. And maybe the biggest lesson is this: when something feels too easy, too fast, too good to be true, it usually is. If you found this video informative and want more deep, simple breakdowns of global events like this, make sure to subscribe to the channel. Because the world is changing fast, and understanding it has never been more important. Until next time.